Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at Microsoft.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we unpack today's massive paradox, here is a really useful chart tool for investors and traders. If you want help reading trading charts more clearly, just seeing the data better, you can check out VIP Algos through the link below in the description.
Yeah, it's a super helpful TradingView indicator suite.
Exactly. It shows visual buy and sell chart alerts, trend direction tools, support and resistance zones, and even areas for take profit and stop loss planning. And you can use it across a bunch of markets like stocks, forex, crypto, gold, futures, all of that.
Just remember, though, VIP Algos is strictly an educational chart analysis tool. It is not financial advice.
Right. It does not place trades for you, and it absolutely does not guarantee profits. Trading involves risks, so always manage your risk and, do your own research.
And just to be fully transparent, this is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
Okay, so getting into today's topic, we have an incredible contradiction happening in the market right this second.
Oh, it's wild. Like, if you are watching this tech giant right now, you are basically seeing two completely different realities play out.
Totally. On one hand, the numbers they just reported are, they're earth-shattering, just massive.
But on the other hand, the stock is taking a brutal beating. We're talking about the worst single month of performance we've seen since the dot-com crash in 2000 or the financial crisis in 2008.
Yeah, it's been rough. So the core question you really have to ask yourself today is, are we looking at a business model that is fundamentally breaking down under the weight of its own ambition?
Right. Or is this like a generational buying opportunity that's just hidden behind a massive wall of short-term panic?
That's the ultimate tug of war right now. You've got Wall Street analysts absolutely obsessing over these immediate massive infrastructure costs,
while the actual underlying business is completely reinventing how it makes money.
Exactly. All right, let's move into the wealth building context.
Yeah, this is the most critical lens to use, really, because if you're approaching this as a quick, like a short-term day trade to just flip in a week,
you're entirely missing the plot.
Literally. What we are witnessing here is a foundational structural shift in the core business model.
Right. For decades, this was a company built on a capped per seat license model.
Let's break that down a bit.
Yeah.
Under that old model, if an enterprise client had, say, 10,000 employees, they bought 10,000 software licenses.
And that was it.
Right. That was the absolute ceiling on how much revenue could be extracted from that specific client. There was a hard cap.
Precisely. The revenue was completely tethered to human headcount. But, that old model is dying out.
Yeah, they're currently transitioning to what's called an uncapped seats plus consumption model.
I like to think of the old model like buying a ticket to an all-you-can-eat buffet. You pay one flat fee no matter how much you eat.
But the new consumption model is, it's like paying for every single bite you take.
That's the perfect way to put it. And with artificial intelligence, companies are taking massive, massive bites.
Oh, for sure. Every single time a user queries an AI agent, it burns computing power.
And that drives usage-based billing. It scales organically, infinitely, without being limited by how many human employees a company actually has.
Which changes the entire dynamic of the business. For you, as an investor building a long-term portfolio, this is how you have to frame the narrative.
You're looking at a foundational mega-cap company that is ripping out its old revenue engine and replacing it with a far more powerful one.
All while flying at 30,000 feet, right? That kind of massive transition requires a multi-year horizon.
Absolutely. You cannot realistically expect a total infrastructure shift to pay off in 3 weeks.
No, you have to be willing to let those investments bake into the actual bottom line over a period of years.
And the proof that they have the stamina to survive that multi-year transition is sitting right there in the ledger. Now let's look at the fundamentals.
Yeah, because the numbers coming out of that Q3 2026 report are just staggering.
Total revenue hit $82.9 billion. That is up 18% year over year.
Huge. But the real story is under the hood, right?
Always. The cloud division alone hit $54.5 billion, growing at 29%.
And Azure, which is the actual physical infrastructure backbone running all these cloud services, that grew at 40%.
Completely crushing market expectations. But the absolute standout, the metric that changes everything about how this business is valued, is the artificial intelligence revenue.
Oh, the AI numbers are insane.
They really are. It has officially surpassed a $37 billion annual run rate, and it is growing at a blistering 123%.
Okay, let me pause you there just to clarify for everyone listening. When we say run rate, we mean that if you take their current monthly or quarterly AI revenue and project it out over a full 12 months.
Right. It equates to a $37 billion business on its own.
Exactly. And growing that base at 123% is objectively incredible. But, as someone who looks deeply at risk, I have to play devil's advocate here for a second.
Sure, go for it.
I see some glaring red flags when we talk about profitability. I mean, gross margins have dropped down to 67.6%.
Which is the lowest we've seen since 2022.
Right. And it's apparently being dragged down heavily by data center depreciation. Can you explain why that is eating into profits so badly?
Yeah, it comes down to accounting mechanics. When a company buys a server, it loses value every single day, much like driving a brand new car off the lot.
Oh, sure. Depreciation.
Right. Accounting rules force companies to deduct that lost value, that depreciation, from their profits over time. Because they're building so many data centers right now, that depreciation cost is just massive.
So it artificially drags down the gross margin percentage on paper.
Exactly, on paper.
Okay, but it's not just paper losses, is it? Looking at the actual cash, the free cash flow, the money left over after paying operating expenses and capital expenditures, that was constrained to $15.8 billion for the quarter.
Yeah, it's tight.
And the reason it's constrained is because capital spending was a jaw-dropping $31.9 billion in just 3 months.
A massive number.
So the natural, skeptical question a lot of investors have right now is, are they just bleeding out their cash reserves to chase an AI mirage? Are they building a field of dreams just hoping customers will eventually show up?
That is the exact fear driving the current sell-off. But let me reframe that capital expenditure for you. This is not speculative spending.
Oh, so?
Think of it like a highly exclusive, world-renowned restaurant. If they decide to spend $50 million expanding their kitchen, that looks like a terrible, reckless drain on cash.
Right, until you realize they already have 5 years' worth of non-refundable reservations booked and paid for in advance.
Exactly. The money they are spending on data centers is entirely to fulfill a staggering $627 billion contracted backlog.
$627 billion, just sitting there waiting to be processed.
Yes, and that backlog is up 99% year over year. So the cash they are spending right now is literally just the cost of delivering on contracts that are already signed and legally binding.
That is a crucial distinction.
It is. And if you are at all worried about their financial health while they build this out, let's look at the balance sheet. They generated $170.1 billion in operating cash flow.
Wow.
Yeah. Even with this massive spending spree, their debt sits at an incredibly low 2.2% of their total market cap.
Just 2.2%.
Yep. For context, the average debt-to-market cap ratio for the broader S&P 500 is 20.8%.
That's incredible. They have arguably one of the most bulletproof balance sheets on the planet.
They really do.
Knowing they have that massive cushion to fall back on changes the picture completely. That brings us to the catalyst timeline.
Looking at the calendar, the most immediate event on the horizon is the late July 2026 earnings report.
That's going to be the absolute proving ground.
Oh, without a doubt. The primary metric every single analyst will be obsessing over is whether Azure can sustain that 40% growth rate.
Right, because if Azure growth slips to, say, 35% or 34%, the market will instantly start questioning if the enterprise demand for AI infrastructure is already plateauing.
Exactly.
But I'd argue it's not just about the revenue growth. It's about the forward guidance on that capital expenditure.
You think the CapEx guidance is more important?
For sentiment, yeah. Investors are desperate for management to provide some kind of relief or at least signal a plateau on how much cash they plan to burn building out these data centers.
That is the big test for the upcoming earnings call, for sure. But beneath those headline numbers, there are massive structural shifts happening behind the scenes. We are watching the ongoing transition of GitHub Copilot and their massive customer service modules moving directly into those consumption-based pricing layers we talked about earlier.
How does that actually work mechanically? I mean, how does a software tool register as consumption?
It is fascinating. In the past, a company just bought access to the coding software for their developers. One fee, you're done.
Right.
Now, with GitHub Copilot, every time a developer uses the tool to auto-complete a block of code or analyze a script, it pings the server. It registers as a microtransaction of compute consumption.
Oh, wow. So every single prompt burns processing power, generating incremental revenue.
Exactly. When those consumption metrics start heavily influencing forward revenue guidance, it fundamentally changes how analysts have to model the future cash flows.
You also have to connect this to the broader macro environment, right? I mean, we've seen a massive historic run-up in semiconductor stocks, the companies actually making the physical chips.
Like Micron.
Yeah, exactly. But if enterprise IT budgets remain stable through late 2026, we could see a massive rotation in the market.
Capital flowing back to software.
Exactly. Investors love to take their profits out of overextended hardware names and rotate that capital directly back into the software platforms that are actually using those chips to generate recurring revenue.
That makes perfect sense.
If that rotation triggers, a stock sitting at these depressed levels is primed for a violent relief rally.
Speaking of depressed levels, we need to look at how the market is visually pricing this. Now let's pivot to the chart.
Let's do it.
The price structure over the last few months has been nothing short of painful for anyone holding through this transition. The stock is down 23.6% year-to-date.
Brutal.
It is currently trading roughly 31% below its 52-week high.
You have an absolute asset class leader essentially experiencing its own private bear market, completely disconnecting from the broader optimism in the tech sector.
It's bizarre to watch.
Which is exactly what catches my attention as a contrarian. When you have a severe breakdown like this in a fundamentally sound megacap, it pushes the valuation to a near-decade low relative to its historical averages.
The market is aggressively pricing in a catastrophic failure of the AI spending cycle.
But based on that $627 billion backlog we just talked about, that fear just isn't aligning with the financial reality.
And we are already seeing the momentum begin to shift. Just recently, we saw a sharp, violent 5% gap up in the stock price.
For those who might not watch charts daily, a gap up means the price jumped instantly overnight. It closed at one price on Tuesday and opened 5% higher on Wednesday morning, with absolutely zero trading happening in between.
It is a sign of massive, sudden demand.
So what actually caused it?
It was triggered by the news that legendary value investor Michael Burry, the big short guy himself, took a significant long position in the stock.
Ah, Burry. That's huge.
Right. When you see smart money stepping in during maximum fear, it often indicates that the oversold conditions are stretched to their absolute limit and ready to snap back.
It really highlights how extreme the volatility has become. I mean, when you get a 5% instant jump on a trillion-dollar company just because of a single institutional filing, the price action is incredibly choppy.
It's very erratic right now.
And a quick note, volatile price action like this is exactly why active traders rely on incredibly clean chart workflows. You have to be able to clearly spot those underlying support levels when a heavy sell-off is happening, just to make sense of the noise and not trade entirely on emotion.
That is so true.
Let's talk about those emotions, actually. So what does market sentiment look like?
It is a fascinating disconnect between the mainstream media narrative and the actual institutional analysts.
How so?
Well, if you look at the media, there is this relentless hyper-focus on hyperscaler capital expenditure fears.
And a hyperscaler is basically one of the massive cloud providers that runs millions of servers, right? The company's operating at a scale that dictates the entire internet.
Yes, the absolute giants of the cloud. Every media headline is talking about how this is the worst month since 2008, how the hyperscaler AI bubble is bursting, and how the infrastructure costs are totally unsustainable.
It's entirely panic-driven.
It really is. But Wall Street analysts are almost entirely ignoring that media noise.
Really?
Yeah. Out of 55 analysts covering the stock, 52 rate it a solid buy.
Wow. 52 out of 55.
And the consensus target price is sitting all the way up at $561.39. That implies a massive, massive upside from where it is trading today.
That discrepancy brings us back to the smart money flow, honestly. Michael Burry's Cyan Asset Management going long is not just a random blip.
Not at all.
Burry is a notorious value investor. He actively hunts for deep, irrational discrepancies between a company's underlying cash flow and its current market price.
Right, he looks for the mispricing.
Exactly. When a legendary value investor decides to go bottom fishing in a massive tech stock that is usually priced for perfection, it tells you that the risk-to-reward profile has likely skewed heavily to the upside.
The downside risk has essentially been flushed out by the retail panic.
That makes a lot of sense.
There is also quite a bit of speculative buzz operating under the surface that is improving sentiment. For example, there's the recent 5G partnership with Tech Mahindra, which is pushing AI deeply into telecom modernization.
What does AI actually do for telecom? I mean, how does that work?
Well, instead of static routing, where networks just push data blindly, AI can predict network congestion and optimize traffic routing on the fly.
Oh, so it makes it way more efficient.
Exactly, saving telecoms billions in infrastructure costs. It's a huge new market.
Well,
And on an even larger scale, there is intense speculation around Microsoft's 27% stake in OpenAI.
oh, yeah, that OpenAI stake.
That stake alone is currently valued at roughly $135 billion.
Unbelievable.
People are watching closely to see when the $3.1 billion in losses from the first quarter of fiscal year 2026 will start to narrow now that the partnership has been restructured to be more profitable.
All the upside potential is incredibly compelling. But to be objective, we really have to look at the dark clouds here. Now, let's talk about the risks.
We definitely need to cover those.
We absolutely cannot ignore the $190 billion elephant in the room. Management is projecting capital expenditures to hit $190 billion in 2026 alone.
It's a staggering figure.
That is a 61% jump from previous level. Let's just pause and process that number. $190 billion. That is enough cash to fund a comprehensive global space program, or literally buy several small countries outright.
It's hard to even wrap your head around.
They are spending more on data centers and servers in a single year than the entire total market cap of most companies in the Fortune 500. The execution risk at that scale is immense.
Oh, absolutely.
If the macroeconomy falters and enterprises pull back their IT spending, that $190 billion bill still comes due.
That is the most significant bear argument. And what makes it worse is that a significant chunk of that spending isn't even buying them more computing capacity.
Wait, really? What's it doing?
It's just paying for inflation.
The hardware headwind.
Yes. If you are holding the stock right now, hearing about the memory costs is probably going to make your stomach drop. Within that massive CapEx number, there is a $25 billion headwind purely from the cost of memory.
Because AI requires incredibly fast, high-bandwidth RAM to process data, right?
Exactly. And tech experts are warning that the AI-driven RAM shortage is not going to ease until 2028.
So this means that elevated infrastructure costs are a structural issue for the next 2 years.
Correct. It's going to continually suppress free cash flow simply because every server they build is costing them significantly more than it did 2 years ago.
That is a very real drag on margins. And beyond the balance sheet, there is the ever-present regulatory landscape.
Oh, the legal hurdles. It's a cost of being a monopoly, really.
Yeah. Currently, there is an ongoing EU antitrust probe, specifically targeting Azure's cloud practices and how they bundle services.
Right.
On top of that, you have Italian regulatory bodies probing the pricing structures around Copilot, questioning if it's anti-competitive.
And don't forget the lawsuits. Just in late June, we saw securities class actions filed alleging that the company artificially overstated its Copilot adoption rates to mislead investors.
It's a lot of heat all at once.
I acknowledge all of those risks, and they are significant. But we really need to ground them in historical context. Let's start with the legal and regulatory probes.
Okay, how so?
These are essentially standard operating procedure for mega-cap tech companies. Historically, these probes result in heavy fines. And while a $1 billion fine sounds massive to us, they can easily pay it out of their $170 billion in operating cash flow.
So it's just the cost of doing business.
Pretty much. It rarely results in the structural destruction of the actual business model. And regarding that terrifying $190 billion capital expenditure and the squeezed margins, yes, it looks horrific on a spreadsheet. But you have to remember that fear is exactly what caused the 23.6% year-to-date decline. The market has already priced in the absolute worst-case scenario for that spending.
You're saying the panic is already baked into the stock price.
I am.
So with everything on the table, what's the final verdict?
When you synthesize all of this, the staggering fundamentals, the technical chart breakdowns, the sentiment divergence, and the very real execution risks, the resulting rating is an 8 out of 10 bullish score.
So if we had to distill this into an elevator pitch for you as an investor, here it is. The broader market is currently entirely blinded by a hyper-focus on that $190 billion in capital expenditure.
Completely blinded.
The absolute terror over that spending is completely overshadowing a highly lucrative, legally locked-in $627 billion contracted revenue backlog.
You are looking at a generational tech leader transitioning to a highly profitable, consumption-based pricing model.
And right now, the stock is trading at a near-decade low valuation because of short-term margin panic.
But the crucial caveat here is the target horizon. The analysis strongly suggests this is very much a multi-year hold.
Right, you cannot buy this expecting it to resolve in a month.
No. Investors must be willing to wait 24 to 36 months for this massive AI infrastructure build-out and the shift to consumption-based pricing to fully translate down to the bottom line. It requires profound patience.
And we want to leave you with a final provocative thought to mull over as you watch this space evolve. For decades, as we discussed, software revenue was entirely capped by how many human employees a company had.
You simply couldn't sell more software licenses than there were physical desks in an office.
But what happens to this company's revenue ceiling when artificial intelligence agents become the new employees?
That's the real question.
We are talking about digital workers that are infinitely scalable, constantly operating, and continuously burning compute power 24 hours a day, 7 days a week. When the user base is no longer limited by human headcount, the revenue ceiling essentially ceases to exist.
It's a paradigm shift.
It really is. And if you want a cleaner way to read trading charts as you navigate these markets, check out VIP Algos through the link below in the description.
It's a great resource.
Yeah, VIP Algos is a TradingView indicator suite with visual buy and sell alerts, trend direction tools, support and resistance zones, and TP and SL planning areas.
It can really help make charts easier to scan.
Yeah, but it is still only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves risk, so always do your own research and manage your risk.
Absolutely.
This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this analysis helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua Talk.